Hello, I'm Joseph Graff. This video is one part of a 500-part video series where I analyze the 500 largest companies in America. If you'd like to check out my other videos where I conduct stock analysis on other companies, I will include the link in the description. Also, I'd like to say that if you enjoyed today's video, please make sure you hit the like button and subscribe to the channel. Also, hit the notification bell so you'll be notified whenever I post future updates. Lastly, I'd also like to talk about M1 Finance. M1 Finance is running a great promotion right now where if you sign up using my referral link, we both receive $10 that we can use to invest in the stock market. I'll include my referral link below. Thank you all for watching, and here's the video. Walmart was founded in 1962 in Arkansas by Sam Walton. They grew pretty fast, and by 1970, Walmart had become a publicly traded company. Walmart specializes in retail goods ranging from produce to furniture and appliances. Walmart is well known for having a pretty wide variety of products available, making it a one-stop shopping location for many customers. Walmart's operating segments include Walmart US, Walmart International, and Sam's Club. In 2019, the company's largest segment was Walmart US, which was responsible for 65% of the chain's total sales. The Walmart International segment has been growing steadily, with approximately 4% growth between 2017 and 2019. Walmart is currently the 10th largest company in America and is valued at $348 billion. In this next slide, I will be talking about earnings and earnings growth. These two metrics are important because they are the driving force behind a company's valuation and thus the company's stock price. Companies usually report their earnings every quarter. Large, stable companies tend to have positive earnings, while companies with high growth potential may operate at a loss in the hopes that they will become profitable in the future. Understanding a company's earnings and earnings growth goes a long way in being able to accurately value a company. In 2014, Walmart earned $4.88 per share. In 2015, this number jumped up 3.5% to $5.05 per share. In 2016, Walmart earned $4.57 per share, a 9.5% decrease from the previous year. In 2017, Walmart earned $4.38, a 4.1% decrease from the previous year. In 2018, Walmart's earnings dropped again, this time down to $3.28, which was a 25.1% decrease. In 2019, their earnings dropped once again down to $2.26, which was a 31.1% decrease. This data indicates that Walmart's earnings have decreased by an average of 14% annually since 2014. Now that we've looked at the company's earnings, we will now talk about its price-to-earnings ratio, also known as P/E ratio. P/E ratio is calculated by dividing a company's price per share by its past year's earnings per share. Generally, companies with low P/E ratios are considered value stocks, while companies with higher P/E ratios are considered growth stocks. P/E ratio is a useful metric for understanding how Wall Street feels about a stock. In general, a stock with a P/E ratio under 15 means investors are somewhat pessimistic about a company's future, while a P/E ratio above 30 indicates that investors are optimistic about the company's future. As of May 10th of 2020, Walmart was trading at $122.94 per share. This represents a trailing 12-month price-to-earnings ratio of 23.7. This number is slightly higher than the trailing 12-month price-to-earnings ratio of the Standard & Poor's 500, which at the time of this recording was about 21. In this next slide, I will be talking about the company's price-to-earnings growth ratio, also known as PEG ratio. This ratio is calculated by taking a company's P/E ratio and dividing it by the company's growth rate in terms of a percentage. It is generally thought that companies with a PEG equal to or around 1 are fairly valued. Companies with a PEG above 1 may be overvalued, while companies with a PEG ratio below 1 may be undervalued. PEG is a popular metric among many investors because it takes both a company's earnings as well as earnings growth into account. As of March 10th of 2020, Walmart was trading at $122.94 per share. This represents a 4.66 trailing 12-month price to earnings growth ratio. This indicates that Walmart may be overvalued if this is the sole metric you use to evaluate Walmart's stock. In this next slide, we will go over the company's dividend yield, dividend growth rate, and dividend payout ratio. Dividends are generally a sign of a healthy, profitable, mature company. It does, however, indicate that the company feels it has limited growth prospects as the company is choosing to pay cash to shareholders rather than reinvesting it into growth opportunities. Dividend growth rate is the rate that a company grows its dividend payments year over year. A high dividend growth rate is usually seen as a positive to investors. Dividend payout ratio is another important metric. It represents the percentage of a company's profits that it pays out as dividends. A payout ratio below 60% usually indicates that the company's dividend is safe and has room to grow in the future. A payout ratio above 100% means the company will almost certainly cut its dividend, as that means that the company is paying out more in dividends than it is earning. As of May 10th of 2020, Walmart currently offers a dividend yield of 1.76% as they pay 54 cents per share per quarter. Walmart most recently raised their dividend in March of 2020 when they increased it from 53 cents per share up 1 penny to 54 cents per share per quarter. Walmart over the past 5 years has increased their dividend by an average of 2.3% per year. Walmart's dividend payout ratio is currently 44% based on the past 12 months of earnings. This indicates that their dividend is pretty safe and probably has some room to grow in the future. In this next slide, we will be going over the company's price to book ratio as well as its debt to equity ratio. The book value of a company is essentially the value of all of its assets. Book value per share is simply the book value divided by the number of outstanding shares. Furthermore, the company's price to book is just its price per share divided by its book value per share. This metric can help you understand if a stock may be undervalued or overvalued. A company's debt to equity ratio is calculated by taking the sum of all of its debts or liabilities and dividing it by the total shareholder equity. In general, companies with a lower debt to equity ratio are better equipped to withstand an economic downturn. Debt, however, can be used by companies to grow and expand, which is why a high debt to equity ratio is not necessarily a bad thing. As of January of 2020, Walmart had a book value per share of $26.67. This represents a price to book ratio of 4.6. As of January 2020, Walmart had a debt to equity ratio of 0.79. This isn't too terribly high, but it is a little bit higher than some of the other companies that I have done stock analysis on so far. It's a little bit on the higher end for large companies in the US. In the next slide, we will look at the company's 3-year, 5-year, and 10-year return. A company's past performance does not predict its future performance. However, it does allow you to see how a company has done in recent years. In general, a steadily increasing stock price indicates a company has been operating successfully. If you had bought Walmart stock on May 1st of 2017, held it for 3 years, and reinvested all the dividends you received, you would have seen an average annual return of 20.3%. If you had bought Walmart stock on May 1st of 2015, held it for 5 years, and reinvested all the dividends you received, you would have seen an average annual return of 11.8%. And if you had bought Walmart stock 10 years ago on May 1st of 2010, held it for all 10 years, and reinvested all the dividends you received, you would have seen an average annual return of 11.3%. In this next slide, I give my grades for this stock. I'll include grades for how I feel this stock is as a defensive investment, a growth investment, as well as an overall investment. My defensive grade takes into account how well I think the company would do in an economic downturn. My growth grade for the company takes into account how much I expect the stock to grow in future years. Finally, my overall grade is my personal opinion on the stock and whether I feel it is a buy or a sell. Keep in mind that these are my own opinions, and I am not recommending you purchase this stock or make any investment without doing your own research. As a defensive investment, I gave Walmart a grade of A-. Walmart's a company that's been around for over 50 years and has stores all over the place. The only thing I'm slightly worried about is a company like Amazon coming in and taking some of their market share. However, I think Walmart has done a good job of starting to establish more of an online presence, and I think this will help them out moving forward. Their dividend is pretty safe. They have a pretty low payout ratio, and I think there's a good chance that they continue to raise this dividend in the future. As a growth investment, I gave Walmart a C-. Part of this is just because they're such a large company, and I just don't see how they could potentially grow much more other than growing their online business. However, I think Amazon has a pretty strong foothold in the online industry, and Walmart's going to have a tough time trying to take market share from Amazon. Overall, I gave Walmart a B. I think it's a pretty good company. There's not a whole lot that really excites me about it, but I think it's a solid investment. I think they'll continue to grow their dividend, and I think we will see some growth in their online sales over the next few years. I like Walmart's future for the most part, but I do worry a little bit about what Amazon might do to it. That'll wrap up today's video. If you enjoyed the video, please make sure you hit the like button down below and subscribe to the channel. I'll be doing this type of video for every stock in the Standard & Poor's 500, so keep your eye out for future videos. Thanks again for watching, and take care.